Most people don't lose money on Binance Futures because their strategy is bad. They lose money because they don't understand how Binance Futures actually work. I'm not saying this from theory. This exact misunderstanding cost me over $1,000 in a single trade on my first Binance Futures trade back in 2019. So, when I say don't trade Binance Futures until you understand this, I'm trying to save you from learning the hard way. So in this video, I will show you how futures traders actually make money even with low win rates, why leverage is misunderstood by almost everyone, and how to place trades on Binance so your risk is defined before you click that buy or sell button. If you understand this, Binance Futures stop being dangerous and start feeling controlled. And just so we are clear here, if you're watching this video looking for how to flip $50 into $10,000 in 1 week, this video is not for you. Let's start with Binance itself. Binance is the biggest exchange in the world, and its futures market stands out mainly because of liquidity. Liquidity simply means that there are always buyers and sellers on both sides of the market. So you can buy and sell at any time without any delay. So it gives you a very tight spread, fast order execution, and low transaction fee. But liquidity also means that there is no mercy if you make a mistake. Your order is going to fill instantly, your stop loss will be triggered, and if your position size is wrong, the market won't give you time to fix it. But it is actually an advantage if you know what you are doing. Binance is not risky because it is bad. It's risky because it assumes you understand futures trading, risk, leverage, and position sizing. And most people don't. So guys, I'm going to break this down in this video. It's very important you pay attention here because this next part, if you don't understand it, don't ever place a trade again on Binance. Futures trading is simply a concept. You are not buying crypto to hold. You are trading price movements. If you go long and price goes up, you make money. If it goes down, you lose money. If you go short and price goes down, you make money. If it goes up, you lose money. That is just it. The skill you need here is determining price direction and the skill to manage your risk if you are wrong. That is basically all traders do. And this brings us to how traders actually make money trading futures. The concept is also simple. You put something in called risk to get something out called reward, knowing that there is always a possibility to lose some or all of what you put in. Before you take a trade, your strategy should include what the ratio of this risk reward should be for every trade. See what I mean? If you risk $10 to make $10, that is a 1-to-1 risk reward. After fees, it's actually closer to 1 to 0.8. This means you need to win at least 6 trades out of every 10 to cover your costs and 7 to be in good profits. And this is extremely difficult to do consistently. Professional traders don't trade like this. Most pro traders win 40 to 60% of the time, and yes, they make profits even at 40% win rate. This is because they use a minimum risk reward ratio of 2. I personally don't take a trade unless I can make 3 times whatever I'm risking, because at that risk reward, my profit is $6,000 over 10 trade when I'm risking $1,000. Now, when I lost over $1,000 in a single trade back in 2019, I actually understood risk reward. What I misunderstood was leverage and position sizing on Binance. If you don't understand this part, you will never place trades correctly on Binance Futures. Leverage does not control your risk. Your risks come from position size and where your stop loss is. Leverage only determines how large a position you allow to open. If my account is $1,000, 10x leverage let me open up to $10,000. 100x leverage let me open up to 100,000. Now, if my calculated position size for that particular trade is say $376, that is all I am using regardless of what the leverage is. So again, leverage does not increase your risk. Using an oversized position is what increases your risk. I'll come back to how to calculate position size and place trade on Binance in a moment. But first, before placing any trade, let's set up Binance. To do that, I'm going to go to Futures under the Binance bottom menu. Then, you see these three dots at the right corner, click on it, then click on Preference, and make sure that the position setting is in hedge mode. You may see here by default already. The next thing you do is asset mode. Single asset mode is okay. Then for unit preference, choose USDT order size. This allows you to trade using the calculated position size and not random quantity. Yeah, you can trade with BTC or initial margin, but that requires further calculation. Now, once you've done this, you're going to go back to the futures homepage. The next thing is to switch this cross margin to isolated margin. Isolated margin limits your risk to one trade, and cross margin puts your entire account on the line. If you use stop loss like I teach, it doesn't really matter if you use isolated or cross margin. However, it matters during black swan events. Stop losses may not trigger and cross margins can wipe out your account completely. This actually happened on October 11, 2025. $19 billion was wiped out because stop losses failed to trigger in that particular chaos. If you use cross margin, one black swan event can empty your entire wallet. Even though this rarely happens, it may not happen in a whole year. Isolated margin, however, keeps the fire contained to just one trade. Now let's place a trade. This trade, we took it within our Telegram community and it went on to full take profit. The link to join that community is in the description of this video. So it is a Solana trade. You can see the entry, the take profit and the stop loss, and it's a 1 to 3 risk reward trade. Now, let's say I'm risking $10 in this trade. To take this trade, the first thing I do is to open the FX crypto calculator. So I'm risking $10 in this particular trade. I'll simply enter my entry and my stop loss. The position size given me here is 376. This is what I will use in the trade. Now let me place this trade on Binance. The first thing, let me fund this account actually. So the money is received, but the money is in my sports wallet. What I have to do is to transfer it to my futures wallet because I want to use it to trade futures. So from the sport wallet, I'm going to choose USDTS and futures. I'm going to choose USDT. This money has been transferred to my futures wallet now. And I'll go back to futures. For the currency, I'll tap here and select SOL USDT perp. Then I can increase my leverage to the highest. Like I said, leverage doesn't matter if you're using the right position size. I'm going to leave it an open, then limit order. It's an old trade anyway. I just want to show you something here. Then for the price, the entry price is 104.05, and the amount, if I click on this USDT beside it, I would just want to make sure that it's in USDT order size. The amount we calculated as position size is 376. That is what we're going to have here. To confirm that it is correct, I'm going to click on advance here. Then if I enter stop loss, so my stop loss is 106.82. So it shows me that my P&L will be 99.99 if this stop loss is hit. This is approximately the $10 we are risking. If I need to take profit is 95.9. You see that my P&L, if this goes my way, is 29.42, which is approximately $30. That is 3 times what I'm risking for this trade. So you see that you're going to get clarity because we use position size before we click confirm and place this trade by clicking open short position. This is a limit order. The trade is not triggered. It will trigger when price rises to my entry. So this tells me everything I need to know before entering my trade. That is trading, not guessing. Now, everything I just showed you, position sizing, stop loss placement, risk control, this is what actually matters in futures trading. Some traders prefer to do this manually like I just did. They enjoy analyzing the charts, calculating risk, and placing the trades themselves. Others understand the process but don't want to execute everything manually every single time. If you are in the second group, that is exactly why we are building Copy Me Crypto. It allows you to copy my trades automatically but still control how much you risk per trade. So you are not blindly copying signals. You are executing trades with proper structure and risk management. I'll leave the link to Copy Me Crypto in the description of this video if you want to check it out. And if you don't, what you need to trade manually the right way is already in this video. Now, the real question is not how to trade Binance Futures. It's whether Binance is even the right place for you. In this video here, I broke down Binance versus Bybit, which one actually suits different type of traders.